I don't think we're really that restrictive, but then again, that's the idea, isn't it? If you look at where markets are priced and the level of real rates compared to, say, pre-COVID, and the pace of growth in the economy, it's hard to say that the economy, that the Fed policy is tight enough to really slow the economy down to the extent that you would usually see to create a downturn in inflation. So what we have is high enough to keep growth at a pace so that the natural rate of inflation, which is what the Fed is really banking on, of 2%, reveals itself slowly over time without creating a recession.
I mean, a previous guest on the show then actually called it transitory, that stickiness in inflation, using that dreaded T word that the Fed perhaps doesn't like to see right now. But is it actually transitory? I mean, we're seeing this uptick, the stickiness that is still continuing to hurt a little bit. Still around 3.6 for the core figure is the anticipation here. Is it as transitory as we think, or would Powell be at risk of ignoring an inflation resurgence?
Well, I think he's a bit at risk. Okay. I think the problem is that when you look through the PPI numbers, you see the rates of inflation slowing in some cases. You see the rates of inflation coming back up again in some of the goods sector because of the upturn in manufacturing activity, small as it is, but it's still it's reaccelerating. But the real problem is that you had this huge jump in the level of prices, and prices change more and more frequently than wages do. And nominal wage growth has slowed, but it's still behind where it was pre-COVID for most job sectors. And that means that there's still going to be a push for higher wage growth going forward, and that's going to manifest itself in service prices.
Yeah, I mean, that's going to be interesting because that's really the point that was shown even just in that PPI figure as well then yesterday. How does the labor market feature into this, especially this CPI print, and just the consistency of where rates are at this time?
Well, I think the best news for the Fed on labor was that you got 170,000. I mean, I think that's a much more normal number to get. I know everybody jumped on it being a slowdown in the economy, but 170, 150, those kinds of numbers are more common when you have an unemployment rate inside of 4%. And the problem was getting 250, 300, right? So the Fed's looking at this. They've got a rolling 3-month rate on inflation that's higher than the year-over-year rate. And the backdrop on that, because remember, inflation is a lagging indicator, and the backdrop on that is a still strong labor market. So that doesn't give you a lot of comfort that the year-over-year rate's going to continue to decelerate. In fact, it starts to tell you it's going to be the opposite. So he's going to stick where he is. He's definitely not going to hike unless we suddenly see jumps in year-over-year over 4%. I don't think anybody really sees that or expects it. So he's just going to still believe that we're going to squeeze it down. But boy, I think he's running a risk here. He's running a risk on that, and he's running a risk on a too strong dollar working against the industrial policy of the administration.